Quas CEO Market Structure Edge. Tim, good morning. How we doing?
Well, how are you?
Doing fantastic.
Good. I never know whether the mic's going to work. And are you getting that weird feedback, or is it just me?
Just you.
It's gone now.
Okay.
It was there for a second.
Okay.
Yeah, and
cool.
Dennis, you're entitled to other people's stuff, but not your own opinion.
Is that how it works? Okay, I got this. Thank you for.
Yeah,
thank
just
you,
clarifying.
Tim.
Yeah, you're welcome.
Opinions on Twitter, man. Everybody's got one, and nobody likes anybody else's opinion unless it's the same as theirs.
Yeah.
Tim,
good to see you. Yeah.
What's on your radar here? We've been talking about Disney and Peloton and airlines all day.
Like everybody else.
Yeah.
Well, the first thing was great literature over the weekend. All the lyrics to Sting's songs from Dream of the Blue Turtles. That's some great literature. So listening to that on Spotify, there's the lead into the market. And then reviewing that stuff there, you don't find that in hip hop. No offense to the hip hop fans, but that's some good stuff.
Okay.
So so you've been talking deals, have you?
Well, yeah, but I'm just curious as to if we can look back to last week, what was the supply and demand of the overall market last week?
Bottomed and picking up. So the demand side was improving. The supply side, which is, you guys know this, but for those who don't, we think of the supply side of the stock market as short volume. And it's we'll skip the backstory, but those are the two core things that we measure. So we're looking at the way that behaviors change the demand for stocks in the short term. These are short-term measures, and the presence of short volume, the amount of trading volume coming from borrowed or created stock. By the way, there was discussion about this on CNBC earlier this morning with Jay Clayton, used to be the head of the SEC.
I saw it.
Did you? Okay.
Yeah.
And they danced around it. I actually thought Andrew Ross Sorkin did a pretty good job there. They danced around this idea of, well, what if it's not real? And I wish they would just come right out and explain that. But last week, Spencer, to finish the answer here, those levels in the S&P 500. So we're taking the components of the S&P 500 and creating an average. And it was 49% of all trading volume last week was short or borrowed, which is the highest number we've ever recorded. Wow. It's ticked down to about 48.3% as we kick off this week. Demand at 3.6 and rising back toward 5. We expected that the market would, as a result, would be up with volatility. Those conditions tell us that the excess supply would undermine rising demand. And so that is exactly what played out. Supply and demand are very good features of the market to understand what's occurring. And it's also a great way to find out whether people believe a deal will happen. If you want to look at Peloton and determine whether something's going to happen there, that's what you want to look at, traders. Okay, so let's have a look at this. And this is true in anything, by the way, traders. If you want to know what the supply, you want to know whether people are short something. And it's very difficult to squeeze a stock today because of the way that the market works. Market makers can create stock. They have to. They're required under the regulations to create a continuous auction market. We've talked about this over and over. They're exempt from the short locate rules. And you have to understand that most of the supply and demand in the market doesn't come from external forces. It comes from internal forces. It is the mechanics of the market that create that. But when short volume vanishes and there are discussions of deals or activism, that's when you know that there is real substance to it. So if we go over here and look at, I've actually got this in the Benzinga February 7 portfolio here. And notice this. This is what you really want to see. You want to see rising demand and falling supply. Those conditions produce gains. Very consistently true. It's true whether you're, whether you're buying or selling cattle or buying or selling stocks. Supply demand divergences is what create higher prices. And we look at Peloton here right at the top of the list. Notice this right off the bat. It is 61% short at present, meaning 6 out of 10 trades involve borrowed stock, we could just say.
Okay.
So sentiment's rising, but short volume is very high. The key behavior is active money. So there are people who are buying stocks thoughtfully who think, yes, something's going to happen. What's interesting is that has not reached a level of belief among the market makers. Look at this very, very high level of supply. This is why this was the best condition right in here. But this demand side's been terrible, right? See all these little peaks here? These are like mountains in the eastern United States. They're just little mounds. And that's what you don't have any demand for Peloton yet, and supply is very high. For belief in a deal to become real, these levels should drop to 30%. It doesn't happen every time. It just happens over 80% of the time. We've been tracking that data a long time. We work on a lot of deal situations over on the corporate side of the business, and this is a very consistent characteristic. So at present, this would tell me that the effort, people may want to buy Peloton. The trouble is Peloton going to want to sell itself for what somebody would be willing to pay for that business? Well, as a business owner, I know what you put into something. And that's good. That tells us we have a long way to go before they reach some kind of.
Tim, can I interrupt you for 1 second?
Please,
can I interrupt you for 1 second?
Yeah.
So this is based on Friday's data, right?
Correct. Yep.
Okay.
Mm-hmm.
Will that change? I think Joel wants to know. Is that what you're going to ask, Joel?
How quickly?
I got excited.
Change, right?
I was wanting to ask the same question. Sorry.
Yeah. It can change dramatically. There's no question. We see
in
that
one
on
day.
Occasion. It could change in a day. It could change in a day. If we look at UPS, the reason UPS shot up, by the way, is because of that. So it went from effectively 56% short about 5 days before they reported results, 4 days, to 39%. That's a very big drop in a stock that is that liquid. So there is a short squeeze. That is an actual short squeeze. We very rarely see them because of the market maker exemption from short locate rules. If you look at Snap as a counterpoint to this, stock that went down 25% during the market, 23.5, and then it jumped 60% after hours. And look at the supply side. So this is created stock. Snap is soaring because there's no supply, but people are buying it with marketable trades. That is, I want 100 shares or less at the best price. And you can hit that with machines. And if the supply side, short volume, rises, it's at 60% right now, at the same time that price does, that tells us there aren't actual sellers of Snap. Who would sell Snap at that level if you owned it where it was 3 months ago, right? So that's how that happens. And it's very important to understand these mechanics, traders. You can't just think, oh, there's a finite supply of stock that is owned by people who then sell it to other people. Sure, that's part of the equation. But a very, very large part of how the market works is the role of market makers from Goldman Sachs to Hudson River Trading, who are going to take the other side of trades at the best price because they have to. That is the market we have. It's what the SEC decided was the top priority. It is more important that there be 100 shares of Snap to sell than that those shares in the trade actually exist. That's a very important thing to understand.
I mean, that's what liquidity is built on in these markets too. I mean, we're not in Kansas anymore where we go back 25 years ago and institutional liquidity was probably the main source of liquidity. I can remember, and Joel would very much know this, as you go back to the 90s, big orders on the books all over the place, liquidity everywhere. And that doesn't exist anymore. The liquidity is still out there. Those institutions are still out there, but they're on the close. They're using VWAP. It's not satisfying instantaneous demand. Like the liquidity that an institution's providing, even if they're just slowly sifting out there, will absorb slowly over time. But if you have a big seller that just comes into the market, it can knock out multiple levels instantaneously if it wasn't for the market makers that are out there. So the dynamics have just completely changed. And that's why you need these market maker exemptions so that we have that continuous market.
Well, there's your trade-off. That's the truth. And to add a couple of points to your very good point about liquidity, you go back before Reg MS and particularly before decimalization. So decimalization occurred in 2001. Reg MS was implemented in 2007. It was finalized in 2005, but it didn't affect the market until 2007. Before that, The average trade size in the market was over 1,100 shares. NASDAQ market makers who were registered were required to offer 1,000 shares at the bid and the offer. Today, the average size in the S&P 500, the average trade size is 103 shares. So the size of the trade has come down by more than 90%. It's a tenth of the size that it used to be. And that's why prices change constantly. There's a big difference between volume and liquidity.
Yes.
Liquidity is how much of something actually exists. Volume is how much it trades. The same stuff can trade over and over and over and over and over. And then you think, and this happens to public companies all the time, that you have a huge buyer or seller when it's just the same stuff churning over and over. Well, that distortion is very important to understand, traders. We talk about these things because to beat the market, you have to understand how it works. And the beginning point is to understand supply and demand, because those are the foundational building blocks for prices are supply and demand. And that's why we measure this stuff.
That's it. And that's why I personally enjoy Tim's segments and enjoy all the insights he brings. And if you want more, it's very simple. Click on the link that's in the on the screen, in the description, and in the chat, marketstructureedge.com. Tim, always a pleasure. We have to get you on Benzinga Live at some point this week if we can figure that out. But have a great rest of your week. And
you guys too.
All right. Thanks for coming
Good
on.
to see you.